Good afternoon. My name is Jamie Bernard, and I'll be talking with you today about mastering the language of financial achievement in product management. I am currently a senior director in product and business strategy, and I am excited to talk about this with you today. I've been doing product management for over 25 years as a senior leader for about 10 of those. And I've learned quite a bit about how product management and our metrics are received in large enterprise. And quite frankly, it's sometimes not great. This is how many organizations view some product management and product development spending. And quite frankly, I don't necessarily blame them. We are emerging from a period where companies investing heavily in new product development looking to drive growth and capturing market share. It was a time of booming spend where innovation was primarily driven by creating the next big thing, seeking to disrupt. And now it feels like we're at this inflection point where we're in this AI driven era. We are at the peak of the hype cycle where the focus has kind of shifted from broad speculative spending that was often experimental, that really is kind of focused now on, if it's not AI, then why are we spending money on it? And if it is AI, how are we transforming the landscape? How are we automating, streamlining, optimizing, et cetera? So as I'm sure you are all feeling, some of you painfully, the conversation has shifted. And I would assert that any spending outside of AI driven innovation in a lot of large enterprises, especially, it's starting to be viewed as less valuable, even wasteful, unless it's another form of automation or operational efficiency gain. That's been a lot of the feedback that I've seen in the large enterprises that I've consulted with over the last couple of years. Organizations are realizing that real opportunity is out there to use all of this product spending that they've been putting out into the market to reduce cost, to enhance customer experience, and create smarter, more adaptable products. So it's really no longer about adding to the portfolio for the sake of growth. It's more about using the power of AI to maximize impact with precision and efficiency. So in short, we're really not in an era of throwing resources and people at new product development without a really solid business case anymore. And if it's outside of AI, the patience level for the lack of calculation and financial projection is really low. And so what does this mean for product management? Right? Like do we just say, "Oh, that was fun," and turn off the lights? I mean, for some products, yes, I think that's where we are. It might be time. If they're not driving value, if they're not aligned with where the business is going, it is absolutely warranted to move on. But for a lot of other products and applications and services, especially in this environment where companies are tightening their belts and, for some folks painfully so, it is more important than ever to be able to justify the investment not only in new product spend, but also just in your portfolio and how you are causally impacting the bottom line, whether it's enablement and what money you're spending and why it's a good decision. So not just for the user, but for the business. And that's really the heart and soul of what we're going to talk about today. This brings us to the dreaded economic conversation. So I like this book a lot by Don Reinertsen, The Principles of Product Development Flow, particularly around his quote around, in the absence of a clear understanding of economics, people will make decisions based on other criteria, often leading to suboptimal outcomes. I believe that many of us have felt this pain deeply and acutely. And the reason why is because it feels like we are on this treadmill. If we're not crystal clear on the economic impact of our investments, it feels like some decisions are misguided or worst, wasteful. It's not enough anymore to say that oh, we will add value and this is going to impact revenue or make things more efficient. And I'm using the quote fingers on purpose because I've seen many business cases make the case of investing into a product or service about that specifically. It might have a financial projection, but the plus or minus variance is so wildly abstract that it gives just a lot of room for interpretation. So what I'm asserting is that from a product management standpoint, we have to get good at showing how what we're advocating to be built or what we're advocating to be changed, how it ties back to revenue, how it ties back to costs, how it ties to margin, and how it moves the needle for the business. I feel like this AI driven pivot in the world that we're in has been a little bit of a wake up call for product folks, especially product organizations, where it's often been a transactional service for a large enterprise to say, okay, we will intake your request and push them into our service organization to get things built. I think product has to be a little bit more active in the business conversation before we spend. So that's where we're getting into the learning objectives here of the webinar. We want to make sure that we talk about defining success at multiple levels, being able to talk to your teams about why they're building, what they're building, and then taking the outcome and output of that build and measuring the right things so that you can take that information and report it up into the portfolio. How is our portfolio adding to the enterprise? And then again, up to that enterprise. And having that causal linkage and being able to translate it is the key piece here. So we want to talk about some of the specific metrics that you might want to lean into to assess your situation and potentially pivot. We'll map our metrics and we'll create some disprovable hypotheses, or we'll talk about using them to create some disprovable hypotheses. And I say disprovable because we want to make sure that when we say we need to build a thing or we need to solve a problem, we have to identify to what end. And if you can't have that conversation where you're not making that definition, that is a little bit of a problem to contextualize for somebody who really wants to understand the value of your product. And then, to be blunt, we need to start talking finance. Make sure that where you're starting enables the dollar or euro and cents conversations. If you can't do that, it becomes really difficult to get somebody to cut you a check to keep building the thing that you're building. As I get into these webinars, I've had a lot of feedback from folks that I want to make sure that we can kind of be real. And that I acknowledge that I see you. I know there are some realities, and some of the things that you pull from today might feel futile. And saying that, just measure it. You need to go measure it and map this out. It just sounds so easy, but I get it. I understand that some of you might be in panic mode because you don't have access to metrics. And we're at a weird time of year right now where having those metrics could make or break your portfolio, or it can have a meaningful impact on the budget that you have for the coming fiscal year. These are some of the traps, for the lack of a better word, that I have seen that are really hard to get out of. And leaders, talking to you, and I mean this kindly, stop it. Stop doing this stuff. It is up to you to help to prevent the chaos of these non-metric metrics. Vanity metrics are things that we have all seen. It's that hyper focus on metrics that really look good on paper, but don't actually move the needle for the business. I mean things like user growth and number of downloads or website traffic. It can make you feel like you're winning, but those are surface level indicators. If you're not tying those to revenue, cost savings, profitability, etc., you might be celebrating wins that really don't actually matter. The over-reliance on productivity. This one is very common in a lot of highly structured organizations where the product management taxonomy is such that you are judged by how much work you've done. And so that often correlates to an organization that will report the number of sprints or stories or story points that were completed. So I caution against doing this in isolation. It's important to make sure you can illustrate your folks are productive, but we want to tie that productivity to impact. Just because your product productive doesn't mean it's impactful. So tying those two together is really critical for illustrating the value that you're bringing to the table. Some folks don't know what your ROI is. They're just told to build it. And I understand that, especially again in large enterprise. I'm a large enterprise baby. So you will hear me refer to large enterprise quite a bit. And it's because that's where I've seen the most dysfunction in product management and the most disconnect from these metrics, and being disconnected from the business case and not having line of sight to the ROI or the analysis that went into it is super common. So I understand that this might not be available to you. I think there's a viable reason to push back and ask, because when products or features are developed without this understanding, it's like throwing darts in the dark. You might hit something, you are just likely to miss or hit the wrong thing. And the cost of missing is a lot higher when resources are tight. And as again, I said earlier, the belts are tightening up. So making sure that we can go beyond just the build and get into the ROI is important. And then lastly, just the notion of chaotic prioritization and stakeholders that have you running on empty. I get it. Sometimes the notion of let me pull your item and put it in the backlog just to quiet someone down is the treadmill that you're on, the hamster wheel. And I understand that. But we can do hard things, and these realities are not where we're stuck. It might be where we are. So hopefully today, as we get into the specifics, we can start to talk about how we can add a little bit more order and guardrail around what we're reporting and sharing out, so that we can use that information to inform the decisions we're making. So we'll talk about that translation of the financial metrics across different levels. And I use the word translating really intentionally. This is largely because senior level executives, if you get into companies like that are mobility companies, they want to understand how many cars they want to sell cars. They want to make sure that they sell their commodities. They want to make sure they sell their services. And getting down into those nitty gritty product level metrics and not being able to translate the financial metrics up the chain can be a detriment to illustrating how you're impactful to the bottom line. We'll map and convert metrics. So I do have a method and an example to walk through. So it's not just about theory today. How we might take that into next and later responsibly. So as we're getting into planning cycles, how can we justify why we're planning what we're planning? And then kind of pushing you to actually do it. There are tools that we can do. I'll make myself available for questions as needed. We'll do some wrap up and as much Q&A as we have time for. But at the end of the day, part of making sure that we get to the end goal here is to identify what are some interesting metrics that we can get to and how might we get those inside the organization. So in this section, we're going to talk about the what as it relates to metrics. In some instances, it might be financial success. In others, it might be financial reality. At some point, we all have to report the state of the union, and it means finding out what the situation is today, whether we like it or not. Now is not the time for hiding our heads in the sand. And I faced the question several times of how do we report unfavorable news whenever we're getting all of this and we have that moment where we go, uh-oh, this doesn't look great. Those numbers then help you in provide recommendations. This is the state today. This is what we believe we can do tomorrow. And here's why we think that. Without having the numbers, you could just be spinning down a slippery slope in a very, very wrong direction. Before we get into some of the how, though, the what here is important. The way that product management has been implemented across a lot of the different enterprises is wildly different. And so I like to make sure that we ground in specific high level definitions on what product level, portfolio level, and enterprise level are in the context of this conversation. So I personally like to use metaphors. They help me frame things in a different light that others and I can understand together. So I like to use the notion of a restaurant when it comes to product, portfolio, and enterprise, where product might be individual product performance, portfolio is the balance of those products, and then the enterprise is the balance of those portfolios assessing the overall health or financial health and market position. And the bonus points here is you can connect all three. We'll also be able to highlight waste. So in the metaphor, in the restaurants, we'll kind of focus on that because I like food. So in this case, if you think of each product like a dish on the menu, you need to know exactly how much it costs, how much you're charging for it, and whether customers love it. The ROI is the profit from each dish, the NPV, so ROI being return on investment, NPV being net present value. That's figuring out if the dish is going to be a hit in the future and profitable then. And CLV, or customer lifetime value, might ask how often customers come back for that dish. If that dish is a flop, we might want to rethink the recipe or take it off the menu, not just keep adding ingredients. However, it is fair to try adding salt once or twice to see if that knocks it on course. But if it doesn't, you can use those metrics to see whether you should keep that dish on the menu. That's where we get to the portfolio. We recognize how to optimize this suite of products to maximize the overall profitability and strategic alignment. So, from a portfolio standpoint, we might look at the portfolio being like a whole menu. So, you're not just focused on one dish, it's that balance of appetizers, main courses, and desserts, right? So, does that entire menu make sense? Are you offering too many low profit items? You want to make sure you have the right mix while you're able to keep customers coming back. Some dishes might have to go, some might have to be experimented on, etc., so that you can keep making sure that you're getting that customer feedback loop. And then lastly, and wildly overly simplified, enterprise level metrics connect how your product decisions impact the broader goals and market competitiveness. So in this instance, the restaurant itself is what you're managing. Every decision about your menu, your pricing, your ingredients, kitchen efficiency, labor cost, all of it impacts the whole business. So we want to make sure we keep our restaurant profitable and competitive, and we make sure that our customers and stakeholders are happy. The goal is to keep the doors open, stay ahead of the competition, and make sure every dish, menu change, or strategy supports the success of the restaurant overall. So if we take that language out of the restaurant and pull it back into large enterprise, that's kind of where we're going to play today. And that's what I'll mean when I talk about product, portfolio, and enterprise in this context. We are going to draw a causal thread between the three where we can. Now, today we're going to primarily focus on product to portfolio because I think that's where the biggest break tends to happen. Now is the time for coffee refills if you haven't done it already, because we will get into a little bit of math, but I want to make sure that we ground in how metrics should define value, or just the fact that metrics should define value for your product. These are the key metrics that help evaluate the financial and operational performance of your product. That's just the long and short of what these are. However, we often see these missing. So if you measure nothing, starting with these three is really helpful because these will help someone managing a product make an informed decision about where you're investing your resources, whether it's people, whether it's technology, hardware, cloud usage, etc. And then you can use those metrics to determine whether to continue or discontinue your direction. When explaining these to someone in finance, the focus should be on showing how the product impacts the bottom line, both in terms of immediate return, like profit, where ROI might ask, is the product worth the investment? And customer lifetime value, where we want to know how valuable our customer is over time. And then, of course, long-term value with net present value. Is the product still valuable tomorrow? These are very good things to ground on, and we'll show how these show up in the product taxonomy. The portfolio metrics define how your products perform as a group. So when we talked about our restaurant metaphor, this would be how is our menu doing? We won't necessarily get into the other portfolios, right? Because our menu itself, if we look at it on its own, is profitable. We might be talking about what that portfolio ROI is. So in short, how profitable is our entire product lineup? We want to look at profitability and resource allocation when we're talking about that. I absolutely love the BCG matrix, the Boston Consulting Group. This shows the right mix of products in your portfolio, and you can categorize them as, into stars and cash cows, question marks, and dogs to help you really get a read on where you might invest, develop, or divest. I find that divesting is one of the hardest things to convince organizations to do because there's so much sunk cost. But having this high level view of what that portfolio looks like makes the conversation easier, as it makes it more objective. And RAR, risk adjusted return. Are you balancing risk and reward? I think risk is often absent from the conversation, and it shouldn't be. It is influenced by lots and lots of math. Portfolio, if you have an MBA on your team, you should work with them or someone over in finance. This all should be built out. If you own a portfolio, this should be information that you have handy or information like it. If you don't, it's time to become friends with your counterpart in finance. Keep in mind that there are many portfolio metrics to choose from. These are the ones that I like. Some of the portfolio metrics are pure revenue. And for simplicity, that's what I'll use in the example to sort of align on, how do we tell this story? So product and portfolio metrics, we have to connect them so they inform enterprise metrics. The hard line connector here in this laddering up to the key metrics, that is on purpose. The dotted line can occur to show that, oh, this is, qualitatively linked, or this is something that might influence the portfolio metric. But the hard line here is to show that causal relationship. And as you're compiling the metrics at your product level and your portfolio level, you should be able to link these to the corporate objectives that you're seeing shared at a lot of your all hands or on your investor site. You should be able to tell the story on how you're connecting to that. So if we make up Netflix and use pricing from long ago, we can contextualize and kind of tell the story, and I'll tell it from the bottom up. Because I think a lot of times we get our enterprise goals, we get our projects that we have to do inside our products cascaded down, and that becomes the fortune telling that we see whether we were right for the year. What I like to do is push from the bottom up when it comes to metrics so that we balance and bring that fortune telling to bear to say, listen, did we actually do it the right way? Did we forecast in a way that was supported by data and can be proven by data in terms of success or failure? So if we start at the product metrics, we'll just focus solely on customer lifetime value, CLV. And let's say that the CLV is 300 US. Our CLV is determined based on the average monthly revenue times the customer lifespan. In this case, we've got $12 a month per customer at 25 months. So if we ladder that up to our portfolio metrics, we can say that our CLV is 300 US, and that's for their lifetime. One of the things that we also have to communicate is that CLV is based on 25 months because the lifetime is longer than a year. The reason for that is if we do the math around just portfolio revenue, and we're just looking at how much we're bringing in, this total customer count of 200 million multiplied by $300 per month, that gets us to $60 billion. We can't say that is our total revenue, because if on an annual basis, we're going way over that, right? So if we normalize that across an annual basis, we can say that in our portfolio of services based on our customer lifetime value, we have $29 billion US in revenue over a 1-year period. If I'm pushing that up the chain, then I might say that we're adding this amount of revenue year over year to our bottom line. Then the enterprise metric can take that into account. If this is our only portfolio, we can say, listen, our current year revenue is 29 billion based on where we're going now. Our prior year was 25. Now we can report on our growth rate using information that was informed down at the product level. And it might be, one specific set of channels. It might be more than that. Either way, we want to make sure that we take this variable at the product level and it's used to inform the calculus that gets us to our enterprise metrics. That is how you tell the financial story of what we're connecting at the product level all the way up through. Now, all the math can go into this. While we will not spend a lot of time here because we're talking about applying concepts in this webinar, and this is not a functional how-to, that would take a lot longer than 45 minutes to an hour, I want to make sure that I included some of these calculations so that you have access to it. Take a screenshot or what have you. This is also going to be, available to you on demand. So I've spent a lot of time in many, many large enterprises over the year, both as an employee and as a consultant, up and down the portfolio stack. And while I understand I have not seen them all, I can say that I have yet to run into a large organization, especially large enterprise product organization, who can consistently tell this story with defensible numbers just inside product. I don't blame them. This is largely due to the implementation of product management in large enterprise as more of a delivery organization. It has happened a lot. Orders are cascaded through an organization after your AOP or your annual operating plan is done. But this is something that you need to get good at as you're developing your product management skill set. I believe that there is tooling that can help us do this, which is part of why we're here today. Because as we expose this information, we can start to leverage some of our tooling to where this doesn't become this very laborious math calculation at all times, right? So that's where we start to contextualize these metrics inside our journey. So we've talked about the metrics in their abstract in terms of these are things you can build. And I gave a really loose, oversimplified example of how a product metric can ladder up to an enterprise. But as I said earlier, I like my metaphors. We used food in our last example. I also like to travel. So I'll use that as an example here that I always use. And this is always also something that as a consultant drives me insane. I feel like a lot of times conversations like the ones that I just had, it's left off here. I drop it and say, okay, here's a great way to do this stuff. Okay, bye. And it feels like I'm on one side of the Grand Canyon, pointing to the other side, going, this is where you need to get to. Good luck with that. But what I'd like to do is take us into something that makes this a little more tangible and accessible and start to approach converting some common existing metrics into financial metrics that helps us build a bridge across the Grand Canyon. Even if it's a rope bridge, it's something to start with that we can start to harden over time. So when I talk about mapping metrics, I like to highlight a bias of mine. I bias along the journey and then create a metrics network through them. Measuring metrics is not just for the sake of measuring. It can be a huge waste of time and resources. And if you're not tracking the right things, you are literally collecting noise. And so what I like to do is make sure that we bias along the journey because it keeps the customer at the center of everything. We don't want to only focus on specific, non-functional requirements or hardware performance and live just inside that number without at least knowing what the customer is using or what it's impacting. Because at the end of the day, if you don't know where your metrics are connected along the journey, then you can't really identify what levers you need to pull as far as what matters and what doesn't and how things impact each other. And so that relationship between leading and lagging indicators along the journey becomes ever present as you start to clarify what is and isn't important to measure for your organization, your product, your services, and your portfolio of products. I advocate the metrics network. You got to start somewhere. Each layer of the product taxonomy should connect either quantitatively or qualitatively, and you build on that as you can. So we're going to look at a sample. We talked about some specific metrics and how to link them. I don't want to lose sight of the learning objective here because I could easily do that and rant about what you measure and how much signal gets lost in noise more than I already have, but we're not going to do that. Today is about connecting what you are measuring through the organizational layers to tell a financial story for better or worse. If you end up filtering out some noise because that's meaningless, then that's your bonus for the day. But we'll build a sample so we can look at how we can start to identify which metrics we might aggregate or pull out to tell a story. I'm going to go through one thread and know that this can feel like a lot to bite off because we have a lot of things to consider along the portfolio journey. So this is what I would consider a very simplified portfolio level map. If I were to take this and plot it along the journey for an e-commerce organization, it might look something like this, where the level 0 capabilities are at the top. So that awareness, evaluation, purchasing, use, maintain, repair, those I would consider level 0. And then we align those to level 1 capabilities, which are just a little bit sliced up in terms of products and business capabilities. The notion of capability mapping, if you haven't done it for your organization, I strongly recommend it. That is where this centers. But the goal here is to decouple it from the dependency on knowing specific technology that you're aligned to. If you bias along the customer journey and you focus on business capability, you've already started to create the more tangible and non-technically consumable metrics conversation, because you're not expecting somebody to know what technology you're using. So from a product manager standpoint, I should have things that I measure inside each of these capabilities that track up to the key metrics for my product or capability into my portfolio. So if we look solely at purchasing, for example, then I might be counting the number of orders placed, because that will be used as a variable in an equation that makes up my average order value, which has a direct impact to product revenue. Both of those things are important for me to measure so I can make decisions on where to invest in my product based on targets. However, I need to make sure that I'm collecting the right data to inform those equations. You'll see various metrics that are informing the math going up, but not everything. And that's largely because you will use metrics to inform local decisions as well. And those local decisions will pull levers for key metrics that you report up to the portfolio. So when I talk about local decisions, there might be individual transaction costs inside a specific product or capability that you could tweak and lower, but there you're not necessarily going to push that up if I stick again inside that purchasing vertical here. If that's the case, that is a viable metric for me to look at, because I can use that to make short-term decisions for my immediate delivery while pulling out the key metrics to push up to portfolio as we get to future horizon. So carrying forward the purchasing, we want to look through the portfolio lens to determine what of these metrics might I aggregate, not just from this capability, but along the journey, so that I can align it to objectives and market behavior, because that's going to be what I use in addition to my metrics to make a decision on where to invest and what comes next and later from a portfolio standpoint. So I really challenge portfolio owners to look beyond the walls of your company and do take outside in. Don't just focus on the completion of what you are to deliver through the end of the year, but also consume how the market is reacting to what it is you're building, so that you can make recommendations and that are grounded in data when you need to do a pivot, particularly if you're building something that might have a lot of attention or a lot of priority from executive leaders. Going down into those portfolio metrics, you'll have a number of different things. So what I've done for this example, or what I am highlighting here, is aggregating the product metrics up to total revenue. So total customer acquisition cost, et cetera. So not only can I take those metrics and inform up the enterprise and identify how we're impacting not only specific products, but through the enterprise objectives, I'm highlighting the results of our efforts, that current strategy. But I can also use the metrics that connect across the journey to see how they impact each other and provide feedback loop down into a product or service or across, to make sure we're not cannibalizing each other, or that I'm not undoing something later in the process that was meant to be optimized earlier. So the portfolio lens, that zoom out, is super important as you're aggregating to see where things are where things are varying along the journey, how they're connected, and then how you can tell the overarching story at the aggregate level. This can and will inform any adjustments that I would make to my strategy or recommend if I'm consulting for somebody at that portfolio level. And then, of course, we would work at the product level to manage any change there. So for this example, we're tying what happens within the order placement, order management, and delivery logistics capabilities, which might be made up of one or more products. We're tying that into the CLV and revenue that I take to the total revenue from the products and capabilities in my portfolio. This will inform our enterprise metrics that you'll often see in investor reports. So I've grabbed three specific ones. One, the revenue growth rate, like we talked about earlier in our fake and cheaper Netflix example. But you can see we also have profit margins and market share. These numbers being reported, it contains all of this data. So when we talk about earlier, I acknowledge that it might feel futile because you just don't know where it comes from. It comes from somewhere. If you're reporting up to a board or if you're reporting to shareholders or investors, it has to exist. And this is why it is important to make friends with your finance department if you haven't already, because these folks can often help expose where those numbers come from, what informs the calculus, so that you as a leader can start to expose the information you need to get there on your own, so that you're not waiting until the end of quarters or the end of years to see how that you might have spent your money in a way that didn't benefit or didn't perform in the way that you thought that it would. You can also connect them to your organization in that way. So the example that we just illustrated, to talk through purchasing on up through revenue growth rate and how you might link some of the metrics together, that is how you can illustrate how an individual capability ties directly to the enterprise impact. Portfolio owners, I would expect, in terms of creating depth in your organization, to teach folks how to do this and to bring them to the conversation so that they're collaborating across the portfolio journey, but also that translation, so you don't get mired down in minutia. That translation then becomes yours to take up to senior leadership, so that you have clarity across the leadership and across down into your individual contributors on how what people are doing is mattering to your organization. So if I remove all of the highlights here, I like this view because it forces guardrails and it forces you to ask what and why you're measuring. I blew through those in a matter of minutes. I know that there is a ton of complexity here, which is hence my recommendation to connect with finance. Start small and start where you can report if you're not already, and go from there. I squished all of this into one PowerPoint slide, but this type of thing ideally should live in an analytics tool, or at worst, a spreadsheet or a collaboration tool like Miro. The Atlassian suite, I know that there's a lot that can be pulled out of there as well. And I would strongly recommend leveraging your tooling in a way to try to pull out what you can, because this frame can help put the guardrails around it and get the information that you need that matters to your leadership, that also creates clarity for your organization. And then, of course, if we zoom out further, we can see how many portfolios connect up to the enterprise metrics, whether it's an aggregation or a calculation. And I will leave it to others far smarter than me to get into the complexities of the enterprise level finance. So unless you are in full-blown KTLO, or keep the lights on mode, and you are not entertaining anything other than fixing, you are building stuff. And there is stuff that comes next, and there is stuff that comes later. So when we translate the product metrics into financial outcomes, we have to do something that everybody hates doing, which is understanding when and how, and to identify and potentially sunset underperforming products or features based on financial analysis and cost benefit evaluations. That should be taken into account in your next and later, not just the build. Adopting economic decision frameworks, including what Reinertsen has highlighted in his book, adopting those principles and prioritizing projects and products that maximize economic value and aligning those to strategic objectives will help you tell your next and later story much more cleanly. In doing so, I like impact mapping. This is a version of it. This is part of, taking your business story that you have to articulate and align to your strategy. If you can causally link down from the benefit of solving or that solution that you're making up to the business objective and your strategic objectives, that is a logical overlay to the portfolio journey that starts to add a lot more dimension to what products and capabilities that you are a steward of in your organization. And by getting into the details of the solution, you have to be able to tell the story of value and how that value is going to benefit you, your customer, and your overarching business goals. One of the things that this also does is acknowledges that you have ideas in your backlog, in your pipeline, that are objectively good, but you must be able to objectively answer whether they are good for us, whether they're good for now, whether they're good for later, or never. And you can't do that if you don't have objective data. And so answering the questions around what specific strategic goals are you hoping to achieve, what problem you're trying to solve, for whom, and to what end, and then what solution do we think will get us there? How will we know it works? Those are the questions that your metrics should be able to answer at each layer of that taxonomy at some point. So when we talk about now, next, and later, I like to use McKinsey's 3 horizons, because if I have my impact map strategy where I know where we're looking to go in the future, I have my metrics for today, and I have all of the smart people in my organization who have done the market research, and we're starting to build out how might we have a backlog that is full of real work and not just a parking lot to get somebody off your back, which I see you, I get it. But we want our backlogs to be recent and not have old things in it. And ideally, we have a mix, an investment mix in there. Sometimes in large enterprise, the investment mix doesn't show up until portfolios. A lot of times, unfortunately, the experiment layer is sequestered off into an innovation team, which is unfortunate, because I believe all backlogs should contain 85% today. For now, what am I doing today to protect my core, to run my business, to protect my business, and make some optimizations that are pretty local, but nothing crazy. 10% of my investment or my backlog should come on what's coming next. What's a way that I can augment my core to kind of where now and later collide, so that we can start to get things that are innovative but connected to what we're building and the value proposition that we have out in the marketplace. That should be something that I can tell and spend 10% of my budget on. The 5% tends to be really focused. If you're an organization older than 30 or 40 years, that 5% tends to evaporate into tech debt remediation, unfortunately. But I would strongly recommend taking a good hard look at your backlog to see, what does this spread look like? And are we so focused on now that our competitors are going to be able to disrupt us, or a startup can come and disrupt us because we don't have time to experiment because we're too busy trying to hold everything together? So having the metrics, telling the story along the impact map with your journey allows you to look at now, next, and later through a few different lenses to really think about, what bet are we making and why are we making it, and how will we know we were successful, not just done. So the goal here is to go forth and measure. First and foremost, though, you have to create the conditions for success. When you do all of this, then you can report the news, you can analyze your portfolio, identify where to invest, and potentially divest. So this infrastructure that I'm talking about isn't necessarily the hardware, right? This is just establishing the product management infrastructure in your operational organization that has these artifacts with a clear owner, that are not built once and shelved, but they are used to enable the process. So journeys, personas, etc., those should be healthy and referenced often. Ensure that you have product management in place beyond backlog management. If you do not, I would challenge you to talk to your senior leadership team about how you might start to expose some of the more business acumen principles in product management, and take ownership of those. Tooling and scale is key here to establishing infrastructure. That's why I said worst case scenario, you've got something in a spreadsheet or in a Miro. It is really hard to keep those alive, especially if you have any turnover, or if you promote somebody, you lose a lot of domain knowledge that you could automate and build into your tooling. To that end, have a metric strategy and monitor it. You cannot know how you're performing if you're not measuring. And then do some customer research. Do it early and often. Make sure you have important customer insights that inform your feedback loops, and market insights. Don't just rely on what customers tell you. Customers are liars. They will tell you they want something and behave a totally different way. I use Spirit Airlines as a an example here, because when you ask customers what they want out of their airline experience, they will tell you things like legroom and comfortable seats. When in reality, the behavior will tell us that the first thing that people sort by is price when they're looking for airfare. So at the end of the day, you can't just listen to what a customer tells you. You have to watch their behavior and see the metrics that support that behavior so that you can find that right mix between desirability and viability. So just some best practices: know what you're measuring today. I've said that 8,000 times, make it 8,001. You have to make sure that you're measuring relevant things so that you're not adding noise to the noise. Iterate. This is not a one-time activity. It should be revisited and revised as the products in the market evolve. Product management should own these associated artifacts. You probably have design partners. They should probably own some of those as well. But when it comes to the things that quantify and tell the business story, I would put the accountability in a product management vertical, and make sure that you have friends in finance who can help you. Which leads me to my next one. Make sure that you are plugged in to your finance department. It's critical. And then crunch the numbers. Learn how to do the math. And if you can't, or if you have the headcount, hire somebody to own that financial piece in your portfolio and create depth in your organization to where that becomes a core competency in your product group. Product managers can't do all the things, they can't own everything, but knowing how to do these specific types of metrics mapping and calculations only elevates how product might be positioned in your organization and will give you credibility. So tips and tricks. Now we've got to talk about some mistakes. Don't just report the green. Highlight wins. It is absolutely important. If you don't do that, that makes some hard things absolutely soul-sucking. And you can't just focus on where we're failing, right? Which a lot of organizations, if it's not green, it's red. Highlight your wins and celebrate them. Zoom in on your losses. Find out what the reason is for it. It is scary, but they're important. Don't neglect market signals. Read the market and do your best to understand the trends. Eric Hoffer, I believe, said, in times of change, learners inherit the earth, while the learned find themselves beautifully equipped to deal with a world that no longer exists. That is what's happening whenever you get so focused on your four walls and you don't pull in market signals. You're going to be a laggard, and that is a very uncomfortable place to be. Don't bias towards your incentive. I never underestimate the power of an executive's bonus to drive decisions. Try to avoid biasing towards your reward, which I know is counterintuitive to human behavior. So I would argue maybe look at how you're rewarding your folks, because as Dr. Goldratt says, show me how you measure me and I will show you how I will behave. If you measure me illogically, I will behave illogically. So try to make sure that you balance what your incentive plan with the things that are really important to your organization. So a quick recap. We talked about some of the more meaningful, sometimes complex metrics and ways to connect them to some defensible financial numbers. We discussed how you can convert those metrics and plot them along your portfolio journey and why, and how we might look across the journey and make some calculated bets as far as where to invest next and later, and the steps needed to do so, not solely focusing inside our walls on that journey, but what's our competition doing? What are some of the trends telling us? So that's what we have for today. I want to thank you for your time and attention. I know this time of year it's particularly trying to find the time to attend these things. So I appreciate very much you spending your time with me today. I trust and hope that you were able to see value in bringing storytelling and narrative into your business case and into your strategic planning. And I hope that you're able to find it useful as you take it into the coming fiscal year. We'll go ahead and talk about how you can connect with us. So if you go out to our website, you can see we have many webinars, events. We have a YouTube channel. You can register for coursework. You'll see in the chat where our YouTube channel is. And if there's any other events and training, please feel free to either scan the QR code or click on the link and join us. We would love to have you. So about Valiantis, Valiantis is dedicated to Atlassian totally. They are 13-time Atlassian Partner of the Year, and 65 of the global Fortune 500 work with Valiantis. They are full stack development center of excellence. They are the largest global collection of Atlassian certifications and 24/7 global coverage with 600 plus very skilled and talented team members who would love to connect with you. So if we can help, these are the ways that Valiantis can help. Uh, Consulting, licensing, integration and development, managed services, and training. So there are ways that these can be tailored to you, tailored to your goals and your products, so that you can leverage your Atlassian products to help tell that financial story and keep that story going as you learn and make different decisions along your journey. So thank you again so much. I very much appreciate folks' time today. If you have any questions, please feel free to email me at the email address that's shared in the chat, and I'll be happy to get back to you on those. I will go ahead and stop sharing my screen. And if there are no questions in the Q&A, I think we can go ahead and move forward. Thank you for your time.